The New Orleans Conference, the world's greatest investment event.
One of the things I want to do this morning is test out a hypothesis I have, and that relates to natural constants. And those are the things in the world that never change. As examples, c, the speed of light in a vacuum, g, the Earth's gravitational constant, pi, the ratio of a circle's circumference to its diameter. These things never change. And I want to propose a new one, that is L. Yeah, I'm naming it after myself. L equals 2.0. And that is the number of years until the next financial crisis. It never seems to change. It doesn't matter what the situation is, what the economy is doing, or who you're with. There is always someone who will say that it's 2 years away. So I want to see if that holds up during this panel and throughout the rest of the day. I'm going to direct, I think, my first question to Ben Hunt, because I'm least familiar with your views, interested in knowing what you have to say. And to be perfectly honest, if you look to your left, this might be the only chance you have this morning to speak.
I know, that's what I understand, yeah. Once it gets to Peter, we're done, yes.
So, yeah, Mike's pretty good too. So let's make it count. Where do you think we are in the global cycle?
Well, look, we're in a bubble. Let's call it the bubble of financial assets or the bubble of everything. And I've got to talk later. We'll show some charts about this. But basically, the idea is that really, as a country, you can't be richer than your economy grows, right? Not for long anyway, and not by a lot. But we're now at kind of the third one of these, I'll call it central bank-induced bubbles, where future growth has been pulled forward, and it manifests itself in net worth of us, right? So you can see this really clearly, right? So we have the dot-com bubble, we had the housing bubble, and now we've got the bubble of everything, right? Which has really been focused on financial assets. So we're in a bubble, right? But to your point about, well, you know, is the financial crisis 2 years away or some year away? What pops that bubble? And I got to tell you, it is different today. The bubble popping process has been made different today because we have a new, I'll call it a gravitational force in the world. And that is the $20 trillion in assets that central banks have bought, right? There's enormous gravity that's formed by that, really starting in 2009. It's still going on today, right? It's topping off, but still going on today. You can't unring that bell, right, to mix a metaphor here. And it really does change everything in terms of the lifespan, the life cycle of bubbles by having this enormous gravitational force there. So I'll give you a quick example on it. So in 2012, summer of 2012, I was running a hedge fund. It's about 800 million, so it wasn't small. And we had a big bet on the euro issues that the ECB was unable to face in the early summer of 2012. And look, I went that summer from having some of the best days of the fund to some of the worst days of the fund, to the point where by the end of the summer, really in that first week in August, when Mario Draghi gave his whatever it takes speech, followed by this entirely mythical program to prop up the European monetary system by making what they call outright monetary transactions, outright purchases of everything. Just those words were enough to alleviate the crisis, because that was a full-blown financial crisis in the summer of 2012, and it was as if it didn't happen. And I got kicked in the teeth with the fund. And what I realized was that our world had really changed, that just understanding the fundamentals, it was no longer enough, right? That we really do have these new forces that are determined to turn capital markets into political utilities. I really believe that's the goal here. And it's a darn effective mechanism they've got here. It's both the words and backing it up with the ability to buy trillions of dollars worth of stuff. So what I'm looking for, to get back to your original point, right? What does pop the bubble? It has to be something that undermines market global whoever confidence in the ability of central bankers to bail us out, to rescue us. And I don't think that that happens with another euro crisis out of Italy, even though I think that could absolutely happen, right? It doesn't happen if China floats the yuan, right? Although I think that could absolutely happen. It doesn't happen if the Fed continues to raise interest rates and spark a cyclical recession here in the United States. None of those things, my view, are big enough to pop this bubble, because none of those things are big enough to undermine that global confidence that you've got central bankers with their words and their money to be able to save the day or prop up our prices. So that's where I am. What I'm looking for is, well, what is it that can undermine that? I think it's inflation. I think inflation can happen. I think that can undermine the confidence that people have that the Fed and the ECB and all these other banks can save the day. But I think that's what it takes to pop the bubble.
Okay, thank you for that, Ben. And I think we'll return to that with Peter. Before we do that, I want to talk to Mike a little bit, because from our discussions yesterday, it sounds like you're not waiting for the catalyst. You're already rotating into cash and maybe into value stocks away from growth. Is that true?
Yeah, that is. I think that some of the market activity that we've seen beginning in January, and especially with what happened in October, tells me to some degree that these background concerns that have been simmering and building up for a long time are now starting to bubble over, if you'll pardon the pun. Ben mentioned it as sort of a bubble of everything. The term I've been working with is the Uber bubble, and it's kind of a play on the fact that Uber means largest, biggest example of it, but also private tech companies' valuations of Uber and many other firms in that industry are are pretty much ridiculous by my standpoint. I haven't made a penny of operating profit in 9 years, and they're worth $120 billion. It's up about 2,220% since it was founded. But that's just one example. I mean, when I look at this sort of bubble cycle that we're in, the last two cycles were very high in amplitude, right? You had an extreme bubble in dot-coms. The rest of the economy, not necessarily impacted as much by that, and then that popped. Housing, same kind of thing, a very amplified sort of wave pattern where the bubble in housing was extreme. Other parts of the economy weren't as touched by it. What's happened this time, in my opinion, is sort of the trough-to-trough measure of this bubble. It's much broader, not as highly amplified, but much broader. And it's in things like stocks, it's in things like high-yield bonds, it's in housing again, commercial real estate again. But if you'll indulge me, there's examples that you're finding in all kinds of other markets that you don't hear about a lot, but it just shows that the asset economy, asset valuations are out of control. We just sold in November 2017 the Salvador Mundi painting. Some people think it's Da Vinci, but they don't know, and it sold for $450 million, which was beat the previous record of $179 million. You have, for example, NFL team. Everybody's kind of interested in what's going to happen with the Saints later around here. The average value of an NFL franchise was up 8% last year, 2% this year, and is up 146% in the last sort of QE period. There's a company called PWCC Marketplace. They track the value of baseball and other trading cards. If you look at what baseball cards have done, for example, they are up 265% in the last several years during the QE era. If you look at vintage comic books and comic book art in Chicago, we just had a sale, $12.2 million total auction value, up 17% from the previous record. I could go on and on. There was a bottle of vintage scotch, actually, that was just auctioned off in October of 2018. It sold for $42,980 an ounce, an all-time record. A 1962 Ferrari just changed hands for $48.4 million, all-time record for any vintage car as well. So again, it's everywhere. So that's when I talk about that wave pattern. It's much broader. It's much more all-encompassing, and it does raise the issue of where do you go to hide if indeed we are, kind of like the ship that's going to hit up against the rocks. And that's the real problem. I think last two cycles were narrower and higher in amplitude. Now they're broader and more dangerous. So that's why, beginning with some of the market activity that we saw in February and March and so on, we've gotten much more defensive. I think the process of unwinding some of this is already beginning.
Thank you. I'm going to go with Peter now, and I think most people in the room are familiar with Peter's background, but I just want to revisit it a little bit, because if you go back to 2004 to 2008, America was really getting drunk on cheap credit, on homes that seemed to appreciate forever. Peter was out there, one of the leading voices, warning of what was going to happen, and he really called it. And I think of it as a playground. The kids are all like just going nuts. And Peter's a cool kid in the back of the room saying, synthetic CDOs suck, man. I'm not participating in that. And he really nailed it. That was then. This is now. Now what I'm seeing is, yes, Peter, you've maintained your opinion on what's going on, but I'm seeing other people come in as well. So now you got guys like Jack Bogle warning. You have investment banks warning that growth is going to slow down over the next couple of years because of what we've done with QE. You have people from the Fed, like Richard Fisher, saying, look, we pulled forward growth, sort of echoing your sentiments, Peter. This can't continue. And then even it goes as far as people like Carl Icahn and Ray Dalio, people who managed a lot of money, warning. And so my question to you, Peter, is, well, it looks like being bearish is not as cool as it was before. It's a bigger club. But now that so many people are actually saying it, what's taking so long? Usually in the public markets, if everyone is looking for the same thing to happen, it happens, correct? So what's taking so long?
Well, first of all, I still think that those warnings are too tepid. So they're just not nearly bearish enough. They don't really appreciate the severity of what is about to happen. They look back at 2008 as some kind of reference point, like, well, that's as bad as it's going to get. So whatever we have now isn't going to be as bad as that. It's going to be a lot worse than 2008. The panel is about bubbles, so I wanted to talk a little bit about bubbles and the nature of bubbles and where they come from. And generally, bubbles are a creation of central banks. I mean, not always. I mean, they didn't create the Beanie Baby bubble. I mean, that was created just, human greed and, bad decisions when it came to Beanie Babies. But when you see rampant, wide-scale bad decisions, generally a central banker is behind it, and they have made a bad decision to create too much money and to artificially manipulate interest rates down. And that is a very important thing because interest rates are an important price in the market economy. And like all prices, they need to be determined by the free market, by supply and demand. Right? Supply is savings, and demand is people who want to invest that savings. And the market is going to find an equilibrium rate. Well, when the government doesn't like the market rate, it tries to set a rate that is below that. And just like whenever the government price fixes something, they create big distortions. They create malinvestments. And the further from the market rate that the central banks put rates, and the longer they leave them there, the more mistakes, the more malinvestments. So the dot-com bubble was a result of the Fed keeping interest rates too low and creating too much money, and for all sorts of reasons during the 1990s. You can remember a lot of the things that were going on, fears about Y2K towards the end, but Russia debt default, Asian collapse in 97, long-term management blowing up. Every time something went wrong, there was Alan Greenspan with more money to make the problems go away. And so that manifests itself in that bubble. But when that bubble popped, right, the Fed came back with even more aggressive monetary policy. They lowered rates down to 1%, which at that time was pretty much a record low. And it took a few years to get them back up to 5%. And so during that period of time, we created this gigantic housing bubble. And there were so many mistakes made during that bubble that when it popped, we had what we now call the financial crisis of 2008, which many people say produced the worst recession since the Great Depression, and it would have been a whole lot worse had we not blown an even bigger bubble. But what the Federal Reserve was able to accomplish now, right, we didn't just stop at 1% when it came to interest rates. We went all the way to 0. And we didn't just leave them there for a year and a half. They were there for 8 years. And the Fed's been raising rates now for about 3 years, and now they've got them all the way back up to 2%. So we have had artificially low interest rates for an unprecedented number of years at an unprecedented low rate. So the mistakes that have been made during this time period dwarf mistakes that have ever been made in any bubble in the past because the bubble is so much bigger. The busts, the recessions that follow, that is the free market trying to fix all the stuff that was done wrong, all the bad decisions, all the misallocations of resources, all the malinvestments. That all needs to get liquidated. That all needs to get cleaned out. And the bigger the boom, the bigger the bust. The problem now is that the boom is so big that the bust will be catastrophic. And what's going to make this bust different is that there is no bailout. There is no stimulus. It is impossible to reflate this bubble. Because as has been said, this is a bubble in everything. They can't make the bubble go someplace else. It already is every place. In fact, the one place there's no bubble is in gold, but there's a bubble in everything else. And that just shows you that there's also a bubble in complacency and optimism. People are so drunk on all this cheap money, they think nothing can go wrong. That's why you have these record low spreads between high yield and credit quality. But all that is changing, right? Rates have been rising, and even though they're at 2%, that's too high when you have so much debt. People keep saying, oh, we're just normalizing rates. Well, fine, but we have an abnormal amount of debt because rates were kept so low for so long, everybody borrowed more money. They can ever be repaid. In fact, it can't even be serviced if interest rates even approach normal. And as far as what the pin is going to be, look, I mean, there's so many possible pins for this bubble. But most people, when you're in a bubble, you can't see the pins. There were a lot of pins that were pretty obvious in 2006, 2007, when I was, forecasting the collapse. There are more pins now. Believe me, there are more things that are going to, it's more obvious now that we're headed for a train wreck.
Peter, can I jump in for a second here? I want to make a point.
All right, yeah, okay.
Based on something that James Grant said yesterday. I'll come back to your point, though. I just want to interject something. Jim Grant spoke, and he said something that was really interesting. He said, like, if you look at sort of scientific progress, engineering progress, it's people standing on the shoulders of other people, learning and improving. Why is it that in economics, it seems like we're stepping on the same darn rake all of the time? Right? And the rake is getting like faster and more dangerous, right? Just this weapons of mass destruction, as Warren Buffett likes to refer to it. But I think it's because each cycle is just a little bit different. People have forgotten. It's just a little bit different enough to fool us. So Peter, one of the things about the call you made in the early 2000s wasn't that you timed it correctly. It was how specific you were about the catalyst that was really impressive. You said, watch subprime defaults. And it all kind of went off of that. Do you see one thing, Ben was saying, possibly inflation. Do you see one thing that we should be watching that might give us a hint that this is about to happen?
Well, I don't know if it's one thing. I mean, we just had that Bank of the Ozarks, what's the new name of it? They just blew up 25% in one day. I think the stock's down 60%. Because of losses on real estate-related loans. I mean, this is a canary in a coal mine that people are ignoring. We had this stuff happening in 07, but you could look at stocks like GE having to eliminate their dividend and crashing to 9, 10-year lows. Look at the auto stocks. Look at the
Peter, are any
stocks.
of those as big as subprime, though? Are any of those as big as subprime?
Well, there isn't. Well, but the problem with subprime is the government now owns the subprime industry. All the subprime loans are owned by the government now. The government basically took that over. But your point is, it is amazing how we've advanced. We know a lot more about science and a lot more about a lot of things than our ancestors. But when it comes to economics, we haven't learned anything. We repeat the mistakes over and over again. And it's crazy that this time the mistakes are so close together. I remember when I was on CNBC, probably in 2005 or 6, when Mark Haynes was still alive, and Mark was kidding me because he said, Peter, bubbles are a once-in-a-lifetime thing, and we just had one in the dot-coms. Are you expecting us to believe that we have another bubble so soon after having the last one? And I said, that's exactly what I want you to believe, because it's the same bubble. It all started with Greenspan, and it's continued. It's all part of the same thing, because the government never allows it to fully reflate. The government never allows the free market to fix the problem, because it rushes in with another dose of monetary heroin. So the reason that so many people don't understand that there's a crisis coming now is because they never understood the problem. They think the Fed solved the problem. They don't understand that the Fed made the very problem that caused 08 much worse.
I think,
okay, Can I ask you a specific question, Mike?
Yeah, sure.
Wow, what asset class are you most concerned about crashing?
Well, I think
same thing for Ben Hunt as well after.
Sure. To me, the most concerning activity that I see is almost the parallels that are happening in sort of the private tech valuation world that we saw in public tech back in the dot-com peak. I mean, if you look at where sort of the easy money has flooded most aggressively this time, it's in the corporate arena versus mortgages. It's also in the incredible amounts of money that you have seen thrown at private tech companies of all different kinds, and that are manifesting themselves in so many places. I mean, I mentioned Uber earlier as one example. example. But if you look at like a DoorDash, for example, they're valued at something like $4 billion, and they deliver food, and they have 500 competitors to do the same thing. It's absolutely ridiculous. They don't make any money, and you can find example after example of that. You look at real estate in the Bay Area as a result of what's happened in the tech market. As of this spring, the average San Francisco house was going up $561.64 per day, or $23.40 per hour. I always joke you could sit on your couch eating Doritos and playing Xbox and make more money than you could by working. And that's what you've seen. So I think if you had to say what part of it is most concerning, I think it's happening in the private and to some degree public tech market. I would point out that as of the first 9 months of this year, 83% of the companies that IPO'd were losing money in the 12 months leading up to their IPO. The only time, literally in history, we saw anything close was in '99 and 2000 when it was 81%.
Yeah.
So
I was about to interject that.
Okay, same question.
Yeah.
Ben Hunt, please.
Yeah, so I'm going to flip it around. For me, it's not what asset class is I'm most worried about. I'm looking at where can I make the most money. And right now, you've got a setup that's actually very similar to the setup in, starting in late '07 and going through '08, where you could buy credit default swaps at basis points, right? So basically, it was a free option on a financial debt instrument that could blow out enormously, right? It's risk and reward, an asymmetry of risk and reward. And today, you've still got that to an extent in the credit default swap market, which is as big or bigger than it ever was back in '07 and '08. But what I'm looking at are long-term interest rates. You don't have to be too cute about this, but the fact is that nobody in markets today believes that long-term interest rates can make a sustained and violent move up. They just don't. Right? So people say, we've got the wage inflation, we've got some inflationary pressures, all true, right? But the perception on markets is that this is cyclical, this is a blip, and that the next deflationary shock, whether it's from Europe or whether it's from the Fed's own actions or whether it's from China, we're just on this long gray slog to nowhere. So on assets and what you can do, you can purchase these very long dated, long-term interest rate swaps or futures, however you want to express it, basically for nothing, right? Because no one believes in markets today that there's any possibility that we get what I'll call a regime change in inflation. Yeah. We've had 30-plus years of declining inflationary expectations. The last 10 years, we've been rocking on just rock bottom on inflation expectations. And what I really believe is that is starting to change.
Yeah,
and
how would you make a point that everybody wants to fight the last war, and if you look at the most recent round of stress tests that the Federal Reserve put the banks through, and they bragged about how the banks passed, but even under their most adverse scenario, interest rates didn't go up; they stayed the same, and inflation went down in their worst case scenario. They cannot even envision a scenario where in a recession, interest rates go up.
That's right.
They can't envision stagflation, even though it happened in the 1970s. Not the 1870s, the 1970s. Everybody on the Federal Reserve was alive in the 1970s, so it's not ancient history. But it's something that they consider so impossible, so implausible, that they're not even stress testing for it. So it's what people don't expect. Nobody expected the collapse of the housing market, even though it was so obvious. Because people told me, real estate prices never go down. It's never happened. Nobody expected it. And so right now, nobody expects inflation, and that's exactly what they're going to get. And they're going to get stagflation, and the Fed can't deal with that.
Well, what's really interesting.
Sorry, can I just follow up with a question for Ben? Just a quick answer. How do you compare the mispricing you see in these interest rate derivatives compared with what we had, with the credit default swaps on CDOs back in the last?
I never thought we would. So in my hedge fund, this is how we made our we made our bones, right, with credit default swaps in '07 and into '08. I never thought I would see it again. How is it possible that we could see that level of excess again?
Is it that level?
It is absolutely at that level.
Okay, thank you. Mike?
Well, I was just going to say, you talk about how people traditionally, for many, many years, stocks go down. What do? You buy treasuries. The money flows from one side of the boat to the other. But what's interesting is even as recently as Friday, you have a day where the Dow's up a couple hundred points. It's down 300 points at the worst, somewhere in that neighborhood. And what happens to treasuries all day? Prices go down, rates go up. And you look at the pattern for the last year and a half in the bond market, steadily declining bond prices, steadily rising interest rates. That is clearly a different pattern. In the short term, we're starting to see it more often, and it makes you wonder, is this like I said, is this the surprise that people aren't expecting, that even if the economy starts to hit the rocks, what happens to rates? They go up.
I mean, people think that, if there's a crisis, people are going to buy bonds, but bonds are also in a bubble. They're one of the bubbles that has been inflated. When the stock market crashed 30 years ago, in 1987, yields were at 9%.
But look, Peter,
bonds were a buy.
When there is a crisis, right, people will buy bonds. All right? My point is you need to think of your bond allocation as a tactical allocation, as opposed to a core allocation.
But they won't buy bonds if part of the crisis is sovereign debt and the dollar. I mean, if you're worried about the ability of the U.S. government to pay its debt and to make the interest payments on its debt, and if you're worried about massive money printing in order to monetize that debt, you're not going to have any safety.
I'm with you, Peter, but that is years down the line, right?
Maybe not.
And between that, because the path matters here, right? So when there is a crisis that emanates from China or from Europe, right, or from some emerging market, people will buy U.S. bonds.
You don't know that.
Absolutely, I know that.
I mean, people expect that. Look, even when Standard & Poor's downgraded the U.S. Treasury debt that first time, and I think it's all junk bonds anyway, but they downgraded it, and people were so worried about the downgrade of U.S. Treasuries that they bought U.S. Treasuries as a safe haven.
That's right.
But that irrational behavior
point,
is going to come to an end,
it's
right?
not
Nothing
irrational.
that can't go on for.
I don't
it is
understand this
irrational.
notion that it's irrational, that there's some magical free market genie that's going to come down and undo all the socializations happen in markets. I agree, it has happened in socialization markets. But to say that, magic's going to happen and that will all reverse.
Well, that's not magic. That's just common sense. But if you look around, we don't have all our friends anymore like we used to. I don't think the Chinese are going to step it up, the Russians, the Japanese, the Saudis. Who's going to buy all of these bonds?
Every institutional investor in the world.
I think if you want to focus on bonds, you've got to start with the credit-sensitive side of the market. That's where you're going to have more problems, in my opinion, at least in the first couple of phases of this thing, than you are in government debt. Again, if you look at where the highest risk lending, highest risk borrowing, highest risk behavior is going on, it's clearly on the corporate side versus mortgages last time. There's a lot of garbage debt, garbage securities out there. You look at some of the things a company like WeWork has sold. There's plenty of examples of paper and companies that are going to be in a lot of trouble based on what they've done in the corporate bond market.
And a lot of these companies are going to lose a lot of money. They're not going to be able to buy bonds. But I think if you're talking about bubbles, the bond bubble, for my money, is a bigger bubble than the stock market. So why would you want to take refuge from one bubble by participating in an even bigger bubble?
Because we have to live in the real world, right? And in the real world, we have stocks and bonds, we have government rate instruments, and we can't, most of us can't, step back for 5 years, right, for the popping of the big bubble. We have to play the game.
Well, but you don't have to buy 30-year bonds. You can buy 1 year or 2 year bonds. You can stay in cash. You can buy bonds issued by other governments that have better credit quality. You can buy gold. I mean, there are other assets. It's not just stocks or long-term bonds. There are a lot of other things you could buy.
Yeah. Okay.
I want to ask you guys about going abroad. I know, Peter, your strategy has been foreign equities, right? Getting away from the U.S. Mike, I know that you like to stay in the U.S. And so I guess I'll direct this question to all three of you. Is it possible that sometimes we overrate or overvalue things that are overseas or abroad or less familiar to us? Because if you think about it, our banking crisis was someone else's foreign investment, right? There was someone out there was putting Singaporean teachers into, Lehman Brothers structured products. So what is the value of investing abroad, and are we overvaluing that in terms of diversity? I'll start with Ben.
I don't invest overseas. I don't. I mean, I'm completely opposite on this. I think that given both the deflationary shocks that I think we all see coming, the ultimate inflationary pressures that come from monetization of debt, which I agree is absolutely coming. It's going to happen. And I want to push away from the table of the casino, if you will, right, of public securities, particularly those that are overseas, right? So I'm looking at real assets, particularly at those that are as closer to home as I can get. I want real cash flows as close to home as I can get. That's what I'm focused on.
Mike?
Yeah, what I'm looking at, I mean, again, since that sort of February, March timeframe, I said this at the earlier presentation, it's not greed is good, it's boring is good. I want to be as boring as possible. Consumer staples type things, high yield, low volatility, the portion of money that's still going to be in equities, and in our newsletters, we have 50% some odd range in cash. Those few remaining things that we do have recommended are plays like that. I think domestically, it's important to be domestic versus overseas. It's important to be boring versus extravagant. And I think the one last point that I've made is that you have so much money that has been into the growth over value trade that you have the divergence between the Russell 1000 growth and the Russell 1000 value index is that the widest the broadest spread you've seen except for the 1 year period bracketing the peak of the dot-com bubble. So the stuff that's undervalued, it's not the FANG names and all that other stuff that's on TV all the time. It's your some utilities, consumer staples, things that aren't sexy but are going to save you or make you money even in a rough market, in my opinion.
Mike, are there not any of those boring stocks to be found in overseas markets?
I think the issue to me is really what's going to happen with the U.S. dollar. I'm not negative on the dollar. I actually think that the dollar, as our rates go up and foreign rates don't, as money seeks safe havens, I actually think the dollar is likely more a bullish play than a bearish one, and I think that's going to work against you.
Okay, Peter, your thesis has been sort of the opposite of that weak dollar. Are you still looking overseas?
Yeah, I mean, first of all, I think the valuations are much better in the markets that I'm involved with. But I think more importantly, people are underpricing the political risk in the United States. Not only are our assets very expensive, but there is a real wave of socialism building in this country. I think the Bernie Sanders phenomena is much more important than Trump. Trump was able to win because he was able to tap into the frustration from a bunch of people who knew the economy was a lot weaker than the experts were telling them. But when this bubble pops and we are in recession and a bear market, two very likely events that will occur and will be ongoing in 2020, Trump will be a one-termer and his replacement will be a socialist and Congress will be a socialist. And all of these tax cuts, which people think are permanent, are going to be very temporary because one of the things that they're going to do is they're going to raise taxes rather dramatically. They're going to vilify corporations and greed and capitalism and blame all that for the problems. And they're going to jack up taxes and spending's going to go through the roof. And we're running massive deficits now under Trump, biggest trade deficits, biggest budget deficits in history. Obviously, those records will be broken under the term of who succeeds him. So there's a lot of risk, inflation risk, political risk. I want to be far away from this blast when it happens. I want to look at countries that have better fundamentals, where they have trade surpluses, balanced budgets, budget surpluses, where people are saving money, not just borrowing it, where they have real industry and real production. And yes, the dollar went up on anticipation of the Fed raising rates. Well, last year was the first year in 5 when the dollar went down. Now it's up a little bit again this year because people actually believe we're going to win this trade war. It's impossible for that to happen. We'll see if the dollar finishes the year higher. It's interesting, the dollar is not gaining much traction recently with the markets kind of blowing up and problems happening. But I think the next big move is going to be when either the Fed has to admit that the economy is not as strong as they think, and they're going to change their forward guidance on rates, and the dollar is going to tank, or the markets are going to figure this out and front run the Fed, and the market's going to tank. But when they have to go back to zero, when they have to launch QE4, the dollar is going to fall through the floor.
You think if the U.S. market tanks, that your foreign stocks are going to do well?
As long as the U.S. dollar goes down, foreign stocks will do very well, because the problem for a lot of foreign stocks now is not only the overvalued dollar, but the expectation that the dollar is going to keep rising. When that expectation proves to be false, it's going to provide tremendous relief. Remember, a lot of these foreign markets have dollar debt, and when the dollar loses value, it's like their debt gets forgiven. And all of a sudden, commodities that are priced in dollars become less expensive for people who have other currencies to pay for them. So,
Look, if you invest overseas with dollars, you are taking on currency risk with your investment.
that's exactly
And
what I
it
want.
swamps-
Because I'm
hang-
getting
hang-
rid
let
of
me
the risk
finish,
of the
let me
dollar.
finish. It swamps all of your fundamental analysis of those companies that you're investing in.
Not
you
if the
say,
dollar
they're
goes down.
cheap, well, that's the point. Not if the dollar goes down. If it goes up, you're making another bet.
Yeah,
which
I'm
I
making
promise
a bet
you,
that I think I'm going to win. That
well,
the dollar's going to fall.
then just bet on the dollar. Why are you doing it investing in specific companies?
Because if I own a
Because-
company that earns currencies that are going to go up, then I make a lot more. If I own a foreign stock, I can make money three ways. I can get the dividend on the stock, I can get the appreciation of the company, and I can get the foreign exchange gain. If you want to bet on the dollar, that's fine. That's a bet you want to make. I wouldn't want to make that bet.
No, you are betting on the dollar.
No, I'm
when you
not.
invest
I'm
in
betting
a foreign
against the
stock.
dollar.
You
I'm
just-
betting
you just
by
are.
investing abroad. That's exactly what I'm doing.
All right.
And obviously, betting on the dollar was the right bet. From in 2016 and 2015 and 2014. But I'm in this game to win it. I just don't want to win. I'm not trying to win a few hands. I want to walk away with all the chips. And when this bubble burst, I think the dollar goes down, just like it did when the dot-com bubble burst. The dollar tanked, and it hit an all-time record low in 2008. When the real estate bubble burst, the dollar actually rose. But I think this time it's going to be a repeat of what happened in 2001, only a much bigger decline. Because when the 2008 crisis started, gold was at an all-time record high and the dollar was at an all-time record low. And that's how everybody was positioned. But now nobody is long gold and everybody is short the dollar. So when they get surprised by the events that we have now, it's going to be a big drop in the dollar and a rise in gold.
Gentlemen, just a few minutes left, and I want to turn the attention to gold, because it's been very tough number of years for gold investors. If you look since the crash, 9 years, the stock market's been going up double digits year over year. We've basically been flat. And it occurred to me, back in 2004 when I got married, I'm putting the ring on my wife's finger, and the gentleman is saying, in sickness or in health, till death do you part. I thought he was talking about my wife. I think he was talking about the gold I was putting on her finger, because that trade has required a lot more faith and dedication than anything else that we've experienced as a married couple. And I feel kind of duped, because I think the marriage proposal was a much more honest proposal, meaning that no one told me that my wife was going to look the same 1,000 years from now, or that our marriage wouldn't become tarnished. There were no claims of malleability, like she would become any person I want her to be, and if I miss her, I can't carry a 1-ounce version of her in my pocket. So I'm feeling a little bit disillusioned with the gold trade, and I'm seriously considering a fling with the S&P. If there's anyone in this room who can talk me out of it, it's Peter Schiff. So only 30 seconds, Peter. Your best pitch.
Look, my cufflinks are made of 24 karat gold. Got them from a company called Mene. My cufflinks are going to outperform the S&P over the next 5 years. I mean, gold started this process. When they started blowing up the dot-com bubble, gold was under 300. Right? It got as high as 1,900 in 2011. This game is not over. Right? The fat lady hasn't sung yet. When this final bubble pops, right, gold's going through the roof. I used to think gold was going to 5,000. Now I think that's, I doubt it's only going to go to 5,000. 10,000 may be a more likely target than 5,000. But I do think that by the time this bubble has run its course, you'll be able to buy the Dow Jones for an ounce of gold.
Mike?
And that's where the Dow bottomed out in 1982. And that's where it bottomed out in 1932. So there is precedent for the Dow being worth 1 ounce of gold. And
Mike.
so I think it'll be worth 1 ounce of gold again.
All right, I'll preface this by just saying I'm not a gold bug by nature. There have been times I've liked gold. There's times when I don't. I think gold at this point has two things going for it. It has the fact that, unlike many of these other assets I've talked about, Ben's talked about, and Peter have talked about being radically overvalued, gold is one of those assets that is undervalued and has not been swept up in this mania. That's the first thing. The second thing, frankly, in a higher volatility, higher risk, uber bust scenario, whatever you want to call it, I think that one of the reasons gold declined so much is that the price of volatility itself was extremely low. I mean, we had more days when the VIX was under 10 last year than we've ever had in recorded history. As that increases, gold is going to prove its role as chaos insurance in my book, and it's something you want to own.
All right, so I own gold. I don't own it as an asset. I own it as an insurance policy, and that's exactly the way I think about it. I think right today it's a cheap insurance policy. However, it is an insurance policy that will not pay off until confidence in central banks is broken, not just shaken, but broken. And that is a very long and very difficult and very dicey path. And all the shocks we're talking about, they're not going to break confidence in central banks. It's going to reinforce confidence in central banks. So it's an insurance policy, but don't be expecting it to pay off until everybody says the central banks don't have control over either inflation. Well, that's the only thing they can't have control
How
over.
did it go, though, from 300 to 1900?
Guys, out of time. Final question. How many years till the next recession?
The next recession? So a garden variety cyclical recession in the U.S. within 12 months.
Okay, and the next crisis, serious crisis.
Next serious crisis, 2 years. Yeah, I'll use your 2 years. It's going to be around either China devaluing its currency or around Italy standing up to Germany and the ECB.
Okay, Mike, same question.
I think the markets are already topping. We're already carving out a rounded top, and I think we're probably in recession within the next 12 to 18 months.
Financial crisis on the horizon?
Financial crisis, I believe we're already getting the first canaries in the coal mine, so to speak, and I think the volatility is going to be increasing dramatically, and next year is not going to be a good one for the averages.
Next year, okay. Peter?
Yeah, I would agree. I mean, we could be in recession very soon. I think we're already in a bear market in stocks. People are going to call it a correction until it's officially a bear market, but all bear markets begin as corrections. But I don't think it's going to be focused in Europe or China. I think America is going to be the epicenter, and I think this time people are not going to run towards the blast. They are going to run away from it.
All right, that's it. Ladies and gentlemen, please thank the panel. Thank you very much.